In tonight's video, I want to discuss the weak breadth that's been going on in the stock market since early March. What this means is that fewer stocks have been leading the stock market higher than normal, which makes it harder to find a winning stock because the stock market really just has a few leading stocks that are pushing the indices higher. What's been working so far in 2017 includes large cap tech stocks like Facebook, Amazon, and Tesla, some tech IPOs from last year like Square and Shopify, and of course the semiconductor sector, which has been strong since 2016, led by stocks like Nvidia, and this year with the stock like Applied Optoelectronics. I also want to touch on the importance of staying disciplined and not chasing stocks. This is especially important due to the fact that we only have a few sectors that are really leading things higher. And if trading without a stop loss is the worst thing you can do as a trader, probably the second worst thing you can do is to chase into overextended stocks. And actually, what happens with a lot of traders with low levels of experience is they'll find themselves buying things too late in a rally and then getting stuck without a risk management plan and losing a lot of money because they're buying at the tops of markets. As always, I can be found at nextbigtrade.com, and my stage analysis screening tool is at screener.nextbigtrade.com, and I can be found on Twitter at nextbigtrade. So looking at the stage analysis screener, on the indexes page, we can see that the percentage of stocks in stage 2 in the Nasdaq is less than 50%, and in the New York Stock Exchange is barely over 50%. And these broad indexes are telling you that even though they're in an uptrend, there's a low level of participation as far as breadth is concerned. And if you look at the health page, I've been noticing since early March that the number of strengthening sectors has been lower than the number of weakening sectors. And typically in a strong uptrend, you'll see this number a lot higher than the weakening sectors. So we've seen the reverse for 3 months now, which means that the market's actually been weakening overall from a breadth perspective, but has still been moving higher because there's a lot of large cap stocks that are pushing the indexes higher. And it's really left to be seen whether the market has been correcting through time and can break out again after this period of weakness for the last 3 months, or whether this is going to lead into a more significant stock market correction. Looking at the Triple Q ETF, which is the Nasdaq 100, the top 100 stocks in the Nasdaq, you can see how this index kind of formed this basing formation for a period of over a year, starting in 2015. And actually, after a lengthy consolidation late in 2016, finally has broken out higher this year. And you can see how it's been in an orderly uptrend all year and really has been leading the stock market higher. Notice how it's been outperforming the S&P 500 solidly the entire year. The same thing with the semiconductors. This index actually broke out in the middle of 2016 and has been in an orderly stage 2 uptrend ever since, and really has been the leading sector in the stock market. Now, on the flip side, the small cap stocks, as shown here by the Russell 2000, have struggled so far this year and really have just kind of moved sideways the entire year. And this is an example of how the breadth in the market has been weak, because you've got an index of 2,000 stocks that's barely made any progress, while the larger cap tech stocks have moved higher. Notice how this index has underperformed the S&P 500 all year. So it remains to be seen whether we can see a bounce off the moving average some point soon here in the Russell, or whether this is going to lead into a prolonged kind of correction consolidation. Now, when we talk about chasing stocks, the best time to buy on a continuation buy in a stage 2 uptrend is when a stock gets close to the 30-week moving average once again after a consolidation and then breaks out higher. The worst time to buy is to chase into an uptrend and then have to wait for a consolidation or maybe even a significant correction where stocks can pull back 20 to 30% sometimes after a big run and can leave you with a pretty significant loss if you're chasing at the end of a rally. So the idea is to be a disciplined trader and to not find yourself chasing stocks, but to wait for good buy points and be disciplined. And it takes a lot of times after a stock consolidates for a while, it's harder to buy because there's less confidence that the rally is going to resume, where when you see a strong stock moving up higher day after day, you feel more confident about it continuing to move higher, but in reality, it's less likely to continue an uptrend forever and more likely that it's going to need to consolidate again before continuing its rally. We can see this in a stock like Nvidia, where most stocks in stage 2, they make strong upward thrusting moves followed by consolidation periods where they might not gain any significant ground for a period of weeks to months before a new uptrend begins again. One latest example from Nvidia occurred at the end of 2016 where it had a strong rally to end the year over a period of a couple months. And then Nvidia consolidated for the first 5 months of this year before finally breaking out again over the last 3 weeks. So buying Nvidia late in this rally would have caused you to be sitting on losses for almost 5 months before the stock broke out once again. And you can see on this oscillator down here where this shows the percentage from the 30-week moving average, and anytime you get close to 0 is really where you want to do your continuation buying in a stage 2 uptrend. And these provide good entry points that occur just periodically during a stock's life cycle in stage 2. Now on the stage analysis screener, I've made this process a little bit easier as far as tracking the percentage away from the moving average. If you go to the follow page, you can actually track your own stocks and they're saved in your browser's cookies, but one of the columns shows the percentage away from the 30-week moving average, and I use this value to find stocks that are not too far away from the moving average. My own personal trading rules, I want to find stocks that are less than 20% away from the 30-week moving average for good buy candidates. And I've seen stocks go to 100 to 200% above the moving average, but depending on the size of the stock, the market cap, and the volatility, in general, they can obviously oscillate from that far above to back below the moving average, but really the ideal time to buy is as close to the moving average as possible. Now we'll look at some examples of some winning stocks from this year. The first one is Applied Optoelectronics. Notice how it had a big basing formation for a couple of years before breaking out at the start of this year on big volume and has been in a strong uptrend all during 2017 so far. But going back to what I was talking about buying extended stocks, really the stock since the breakout, which was another good entry point early this year, the next best time to buy was during this correction, which occurred back in April, which it got somewhat close to the moving average. But a lot of times strong stocks don't give you as good of entry points because they are under such accumulation. But still you should look to try to buy as close to the moving average as possible. And you can see that this stock got down to 25% above the moving average when it corrected back in April. Looking at Shopify, after a kind of a basing pattern for a period of a year and a half after the IPO, it had this tight consolidation which broke out again in early 2017 and has been in this strong uptrend ever since, not really letting kind of dip buyers back into the market as of yet. But again, this was a good entry point when it broke out above resistance back in 2017, and we're still waiting for another good entry point if it's going to correct back to the moving average at some point. And all stocks in uptrends have periodic corrections to the moving average. It's just whether you have the discipline or not to wait for that to occur. Now, a great example of greed and euphoria in this current market would happen to be in Bitcoin. And if you've been paying attention to the news, Bitcoin's been in a mini mania over the last couple months. And even though that's been going on, if you look back at this chart, you can see that there's a number of good continuation buy points in Bitcoin going back even to 2015 after the breakout into stage 2, and even in 2016, another time it got close to the moving average once again, or even as late as the start of April, where it had this big correction from over 1200 down to around 900 before it launched into the parabolic uptrend over the last couple months, which Bitcoin has essentially tripled since the start of April. So you can see how this parabolic move, this is what attracts people that don't even trade, that can't get away from the greed of getting in on something that's hot, and they buy into these parabolic uptrends that eventually are going to come crashing back down, and they don't have the discipline to wait for the buy points at the moving average, which is what a disciplined trader using stage analysis would do. So this is how people that don't know how to trade the markets get hurt over and over again, is they chase into something that's hot and they pay the price once these manias that always come crashing down do again and again. One example of how I've applied this method to a stock recently is Age Beverages, a stock I actually bought when it was below 4 and consolidating right at the moving average a few weeks ago, and it broke out not long after I bought it over the last few weeks, about 50% higher after this consolidation. So I used kind of discipline to find a good entry point. And if I was wrong in this stock, my stop loss is somewhere below the moving average, where it would roll over into stage 3 and stage 4. And the idea of buying close to the moving average is, if you're wrong, you have a lower stop loss point to get you out and to get you back into cash to trade something else. If you buy a stock that's too far away from the moving average, then if you're using the moving average as your stop loss point, you have a larger or longer way to go to get to your stop loss, which can mean that you're going to have a bigger loss to know you're wrong. So really, buying as close to the moving average as possible is what you want to do to have a low stop loss to determine where you're wrong at. And I had no idea that this stock would really continue higher this quickly, but I knew that I was at a good buy point because I knew my stop loss point was right below the moving average, and I didn't have a large way to go to know where I'm wrong. So hopefully this video gave you a good overview of kind of what's going on in the market so far in 2017. And if you want to get more information on the stage analysis system, check out my stage analysis page at nextbigtrade.com.